Okay, and we are back. So this is another episode, or should I say the second episode to Battle of the Brands. And today we're going to look at the company Disney, ticker symbol DIS, a competitor to Netflix. I would say like the biggest competitor to Netflix. And hopefully by the end of the video, you'll understand why. So let's go right into it. Let's go. So Disney is a huge company, a lot bigger than what I thought they were. So let's just get right into it because I'm going to give you a brief overlook of the company. I'm going to try to keep it as brief as I can because this is a huge company, well diversified. I can honestly say I like their business model. I didn't even know this much about the company until I looked at the 10K and things like that and seeing how well diversified they are and seeing the innovation that they have and like how they're pretty much contributing to the cut the cord movement where a lot of people move from cable to pretty much streaming services. So they're kind of helping Netflix in a way, but let's just get right into it. So the reason why I would say that Disney is Netflix's top or number one competitor is because they launched Disney Plus in late November 2019, and on the day that they launched, they had like 10 million subscribers off the rip, right? So then recently in 2020, or I should say within 5 months, they're up to 50 million subscribers. Now, remember in the Netflix video, I said Netflix has 167 million subscribers. So they're pretty much 1/3 of Netflix already within 5 months. And Netflix has been going at it for pretty much a couple years. But this is why I would say that Disney is pretty much going to be a big company, or I would say they're a growth company, even though a lot of the valuations would say that they're overvalued. So Disney's selling at 117 bucks a share right now. They have a high PE ratio of about 44. They do still have earnings per share, but with Disney, they're pretty much diversified they have Marvel. So when it comes to like their big media or their box office hits, they're pretty much in the top 10 for like 2019, or they have most of the top 10 for like number one box office hits. Avengers Endgame is like the number one grossed movie in the history of the world with like $800 million in the box office alone. So that doesn't even count like television, and then it's being leased out to like other streaming services. You have the box office that they're pretty much like number one in. They have 33% of the box office media market share. So like all of the companies that make box office movies or movies for like the theater and DVD and all of that, they have 33% of that totally. So that includes like the Disney movies, the Marvel movies, the Lucasfilms, so the Star Wars, and then that also includes the 21st Century Fox acquisition that they just pretty much finalized in 2019. But with that acquisition, they wasn't allowed to take on like the news part or the sports part. They had to pretty much spin that off. So Fox had to spin that off before it was sold to Disney, because under like the FCC laws, the NBC, Fox News, and ABC can't be controlled by like one company, so they had to spin that off. But anyway, they do have like the X-Men and the Simpsons, and with that acquisition, they was able to get another 30% share in Hulu, and Disney already owned 30% in Hulu, so now they up to like 60%. But they listed that they bought like 7% more within Hulu, so they own like 67% of Hulu. So you have all of the Disney movies and all of that, all of the Marvel, all of Lucasfilms, all of 21st Century Fox. You have ESPN under Disney, which is included in one of the bundles with the Disney Plus. Then you have National Geographic, ABC. It's a lot of streaming things or pretty much programs that are under like the Disney umbrella when it comes to streaming. And like ABC has their own streaming app. And with Hulu, they have money. They get money from like advertisement also, and Disney get money from advertisement also with their streaming things. So they also license out a lot of their like property, like so the Disney Channel. They have a contract with service providers for the Disney Channel and other channels that they have, like ESPN and things like that. So Disney is huge and they're growing, and I'm just gonna say it now. Even at $117 a share, I would still say that that's a pretty good deal, even though that's close to its all-time high of $153 a share. So like before the pretty much break in May or March, where pretty much the whole stock market went down, Disney was selling for around like 153, and that was its all-time high. But 117 bucks, you're still getting that deal, and I definitely can say that this is just my opinion, that they will definitely be worth more down the line in the future, especially at the rate that they're growing, that they were able to add 50 million subscribers in like 5 months. That is just ridiculous. The shows that they have, and then you can pretty much go from box office straight to the streaming platform now with them. Now they spend a lot of money on like advertisement and marketing and things like that, but they have the money. They bring in like they brought in $69 billion in revenue in 2019, which is up from like the 2018 and 17, of course, which is pretty good. And I think they have like a net income of like 14 billion or 17 billion or something like that. So they're a pretty profitable company. And even in a slow economy, they're still profitable. Like, even if they sold off all of their theme parks and all of that merchandise, which they do receive a lot of money from, that's like their biggest moneymaker, they still would be profitable by like $43 billion, because it's pretty much broken up into a couple segments. Their company is like, they have, I'm just gonna say 2 segments. They have it broken down into multiple segments. Like they have the media part, which is like the television. Then they have the box office side of things, like the big media. And then they have merchandise, and then like the hotels, the theme parks, and the cruise lines are all just pretty much jumbled up into one segment. And so I'm just gonna say, for this, to simplify, you have the media segment, and then you have like the theme parks and parks and property segment, we'll say that. So the parks and property segment brings in about $26 billion out of the $69 billion, and then the rest pretty much comes from the media side. So that's why I say, even if you remove the theme parks, even though that is the money that they bring in, but like, I think the media services from like the Disney Channel and stuff like that, from them like selling their stuff to service providers, that's like $24 billion right there. But I'm pretty sure like the streaming service and all that is included in that. And then 11 billion is from like the movies side of things, from them like leasing their movies to like movie theaters and stuff like that to be rented out to be watched. And then like another couple billion from other places. But pretty much they're still profitable just on the media side alone. So they are huge. Like I said, they're bigger than what I thought. And one thing that contributed to their growth is, I didn't know that they have a lot of ownerships in a lot of other companies. So they have like a 51% ownership in like A&E, which is like History Channel and a couple other things like that. They own a lot of television programs, but they have like 51% of A&E. And then they own like a streaming service out in India, which contributed to their huge Disney Plus subscription service. I can't think of the name right now. I'll just show it on the screen. But they have like that helped them out with their subscribers. And then owning like Marvel, and pretty much having Avengers be the top grossing movie, and then you do spin-off of shows from that alone. They're pretty smart, I will say that. So that's pretty much it. I will give a brief mention to their CEO, Bob Iger, if you haven't heard of him. Pretty good guy. He's been with ABC before he was with Disney, so he's in the entertainment field. But most of these big deals pretty much happen under Bob Iger. And I mean, what more do I need to say about Bob Iger if you already know him? If you don't know him, look him up. It's hard to find anything bad on the man, but pretty much let's get into the number side of things. Let's go. So Disney, ticker symbol DIS, selling for around 117 to about 120 bucks a share right now currently. And pretty much they have a price to earnings of 44, which will be considered high, but like I said, this might be considered a growth company, and some of the growth is already pretty much priced in. So that's pretty much saying that people are expecting this company to go up in price, so they're willing to pay a little bit more now for that growth down the line. So that's why sometimes you might see a generally high price to earnings, but their earnings per share is like $2.60 per share right now. Before a lot of companies cut their dividend, they were paying a dividend. The percentage isn't listed right now, but it wasn't really high. I think like a 1% dividend or something like that. They were paying a dividend. Then the thing that's scary though is their price to earnings growth is at like an 84. So that is extremely high, because like a 1 is considered fair value. So 84 is extremely high, but this is Disney we're talking about. The streaming service probably will be huge. And like I've said in another video, I probably could see this company taking over like Netflix, just because they have multiple streams of income just on their streaming side alone. Like even with the advertisement, they can get advertisement from Hulu. Hulu brought in like $4 billion by itself outside of Disney. So they have, they're well diversified, I will say that. I definitely will say that. But you gotta look a little bit more deeper. And so you know what I'm gonna say. We're gonna get into my favorite part, the financial statements. So like I've mentioned earlier in this video, their revenue from 2019 was $69 billion. I forgot to mention that they have 223,000 employees, which is a lot. Their revenue from 2019 was $69 billion. They have $5.4 billion in cash on hand, about $15 billion in receivables, so that's money they haven't received yet. So that's probably people that booked like their hotels and all that out further down the road and just haven't like received that service yet. And they have $28 billion in current assets. And when you look at their current liabilities, it's at $31 billion. So that's not good. But for a company of this size and for them to have a $208 billion market cap, it's nothing to finance more capital. It's nothing to like go out into the market, issue more shares or issue some secured debt. It's nothing for them to raise more capital for that short-term debt. So I will say that's not bad, but this is where things get a little bit tricky. So let's look at their total assets versus their total liabilities. So their total assets is $193 billion. Total assets. That's property, plant, equipment, everything, pretty much everything. $193 billion, right? And their total liabilities is $91 billion. Now I know you're thinking like, that's great. That's like a 2-to-1 ratio. You know, you got $2 of assets to pretty much $1 of liabilities. If this company was to shut down, they can pay off all their liabilities and still have money left over. But this is where you have to do your homework, do your research, and really look at these balance sheets. And sometimes you have to go line by line on a balance sheet to see the real numbers right here. So if you ever look at a balance sheet, you'll see a line that says intangible assets. Now, intangible assets is exactly how it sounds. It is something that you cannot touch. It is not nothing that is in the real world. It is pretty much something like you could say intellectual property or something like that. So you could say the characters that Disney owned would be intangible assets, that you could lease these characters out or stuff like that. But for Disney, and I'm gonna show it on the screen, they have their intangible assets, and I should remind you that on that line, companies can put whatever number they want, and it's for a person purchasing it, that asset, that intangible asset, to actually evaluate that and if they want to. But a company can put whatever number they want for an intangible asset. So Disney has $103 billion in intangible assets alone. That's pretty much the bulk of their total assets. Now, I know you're probably thinking that the property, plant, and equipment was the bulk of that $193 billion assets, but it's not. It was only like $31 billion of it, as you can see. So the thing that scared me was that in 2018, their intangible assets was only like around $30 billion or something like that. So what caused that big jump? Now, it's not listed, but my best guess would be the purchase of 21st Century Fox. So you get like all of those X-Men and more Marvel characters pretty much. But I just can't see it jumping up that much to $103 billion, especially since you have to write off about $30-something billion for the purchase of 21st Century Fox, which was shown on the 2019 balance sheet. But let's just get back into it. Like I said, you really got to look at these balance sheets. You really got to sometimes go line by line and see what's really going on. Now, that's for you to judge if they have $103 billion in intangible assets, or if you're willing, or if you have someone willing to pay that. Now, they do lease a lot of their intellectual property to other like vendors, like the Tokyo Disneyland, or the Disneyland in Tokyo isn't owned by Disney at all. They just pretty much lease their intellectual rights for that. But 103 billion is kind of crazy. So let's just keep it rolling and go into the income statement. So with them making $69 billion in revenue, they was able to keep a net income of $11 billion, which is good considering they paid about $42 billion to make that. So their cost of goods is like $42 billion. So that's pretty good. It just makes me think like how much they pay their employees, but let's not get sidetracked here. So when we look at the cash flow statement, they have their EBITDA, I can never pronounce it, but their earnings before interest, deamortization, and all of that good stuff is at 10 billion, 10.9 billion to be exact. And when we look at their capital expenditures, it's not really bad when you look at a company this size. Their capital expenditure is like 4.8 billion, so you left with a free cash flow of 6.1 billion. So a company this size with this many employees is very profitable. That's very good, especially considering the size they are. A lot of their property, plants, and employees are in America. So that's not bad. This company is profitable. And like I mentioned in the beginning of this video, even at $117, I definitely can see this company becoming bigger, especially as things move into like the Internet of Things, is what a lot of people are calling it, the Internet of Things, where we pretty much have everything on the internet, our streaming service and all of that. So as people move into the Internet of Things and pretty much Disney Plus streaming service grow, their stock price will grow. Hopefully they do a split. That'll be really nice, and then it'll make the stock more affordable for a lot of like investors, and then it'll grow from there. They have had splits in the past, and pretty much a split is you get 2 shares for the price of 1. So if you have one stock that was valued at $100, now you have 2 stocks that are $50 each, that equals up to $100. So a split isn't always bad, and it's not as good as what some people think. But you sometimes with a company like this, you would want to split, especially with the future that I think they have. Like I said, a lot of these stocks are speculative. But that's it for Battle of the Brands, or this episode of Battle of the Brands. This was Disney, my take on Disney. If you like the video, hit the like button, hit the subscribe button. If you do decide to invest in Disney, can you at least give me a reason why and what motivated you to invest in Disney? It's not a bad buy, but I definitely recommend you do your own research first. Do not just invest solely off of what I say about Disney, but it doesn't look like a bad investment. I would definitely put this in a growth category, even though they've been around for a long time. A lot of people say this is more a value stock. I'm just gonna say this is a growth stock, but I don't want to keep talking forever, so hey, good luck with your future investments, fail safe wealth, and let's do it.